The market is not a charity. It doesn't hand out free money. Every dollar earned is taken from someone else's mistake, hesitation, or lack of discipline. In candle range theory, we see this truth play out every day. Most traders chase the obvious by waiting for a large candle, like a 9 a.m. candle, and try to capture its range. Everyone wants effortless pips, quick profits, and instant validation. Even, maybe they catch a quick profit once or twice. But the market always takes it back, because they're trading without any strategy, relying purely on luck. If you want to stand among the few, the disciplined minority, you must flip the script. Instead of chasing big candles or big profits, start focusing on small but consistent ones. This is the type of candle you should trade every day. If you do everything right, there will be around 20 pips, or this one around 27 pip, or this will have around 25 pips. These aren't random candles. They may give you smaller profits, but they'll be consistent because the market repeats them, and there's a discipline to trading them. Follow it and you'll earn. In this video, I'll show you a simple high-probability CRT strategy developed from our team's real market experience. Before delving into the strategy, let's begin by understanding the core concepts of CRT with a question. What is candle range theory? Candle range theory, CRT, is a price action method that focuses on each candle's range. Every candle's high and low act as the most important levels that the market's following move will use as a target. The reason is that if you switch to a lower time frame, you'll notice that the high and low of the candle often act as turning points, where liquidity is resting. The simplest form of the theory includes 3 candles, starting with a range candle, which its high and low are its most important parts. The second candle should leave the range to create inducement and manipulation, and the third candle, as the theory says, is the distribution candle, which is the entry candle for us. The point is, the second candle can form as either a bearish or a bullish candle, but it should close inside the range. Let's see it from the liquidity sweep perspective. We always experienced that a candle trades higher than these equal highs, which creates an inducement and results in liquidity above the equal highs, and then returns to close lower. Normally, it is a sign that the price will trade in the opposite direction. That's how the price hunts liquidity before moving sharply in the opposite direction. CRT applies that same logic, allowing us to anticipate when the price is ready to trade the range. Imagine we are in a 3-minute time frame chart, and each candle represents a 3-minute price action. These are the turning levels which count as liquidity levels. Now, if we switch to a 15-minute chart, we will observe them as a single candle. Candle range theory says if the next candle trades above and returns and closes inside the range, it will target the candle's low range for sure. For example, look at this candle. The next candle sweeps liquidity above the high, then trades the range. The same pattern occurs here. This candle sweeps liquidity, then trades the range. Take these 3 candles as one structure. The next candle sweeps liquidity above it, then trades the range. This behavior isn't random, it's a deliberate market dynamic, and it happens every single day. If you believe these movements are just accidental, this strategy isn't for you. Feel free to walk away and search for something else. But if you recognize that price moves with intention, then try to understand. The very same principle is what drives candle range theory. CRT is built on the belief that price moves with purpose, within defined ranges. This is our range candle. Notice how the price briefly breaks above the range with a wick, then quickly returns inside. This is where manipulation takes place. But why do we call it manipulation? Because once that drastic candle closes, it leaves traders with a powerful illusion. Above that high, many traders believe a bullish breakout is coming, so they place a buy order above these highs expecting the price to continue upward. They even place the stop losses below this close. On the other hand, some traders believe in a bearish move. They expect a bearish candle for the next, so they place a sell order below this level and the stop losses will be placed above this high. And this is exactly what market makers want. So much liquidity accumulated there, and the market maker, by creating a manipulation, will grab this liquidity. In this zone, they allow the price to trade just high and low enough to trigger both sides of the market. Their goal is to push the price to trigger stop-loss orders, and that move leaves footprints on the chart. We can observe candles that trade both higher and lower, but then return back into the range. We call them manipulation candles. These candles appear during the manipulation phase. They typically have small bodies and long wicks, a visual sign that market makers are trapping retail orders. And what happens after manipulation? Once accumulation and manipulation are complete, the market begins its true move. In this case, bearish, using the liquidity collected from trapped buyers to fuel momentum. At this point, we expect the price to continue trading within the candle's range and eventually break below its low. These three phases, accumulation, manipulation, and distribution, form what we call the power of three. Now that you understand the core concept of CRT, the accumulation, manipulation, and distribution sequence, it's time to see how to apply it. When a bullish candle forms on the chart, its next candle can be a bearish or bullish candle. If we face a bullish candle that breaks the range of the previous candle and closes above the range, it will be a continuation candle which continues the bullish move, and there is no CRT setup for us. But if we face a candle, bearish or bullish, that breaks the previous candle range and then returns back inside the range, there can be a CRT setup. This type of move creates a manipulation candle, and that's the market maker's footstep we are looking for. Once we confirm it, we should check the lower time frames to identify an entry for a short position, because we know that after manipulation, there will be a distribution phase, which is a bearish move caused by the market maker, and such a move should create an order block. We can apply this to a bearish candle too. When we face a bearish candle, we just need to see a bearish or bullish candle that breaks the range and returns back inside the range. Then we can check the manipulation zone to identify an order block to execute a long order. Now that you understand how to trade CRT, the next question is, when you face a real chart, how do you identify the right candle to trade CRT? Which candle should you actually look for? As you can see, not every candle's range gets traded, so we can't expect to apply CRT to all candles. It seems it just happens randomly. In the past, many traders looked for candles forming at key times, 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. But trust me, I used to trade those time-based candles myself, and that approach often turned out to be risky, especially for less experienced traders. If you try to apply CRT on the wrong candle, you can easily lose profit. The key to success lies in spotting the right candle, and I found that key by trading alongside a powerful trend. Let me show you how it works. First, we want to see a market that's clearly trending, either up or down. In an uptrend, every impulsive move is followed by a correction. If you look closely, each new impulse tends to fill the range of the previous correction, and that correction range is exactly the one we want to trade, because more often than not, the market revisits and fills those ranges. Trading within the correction range gives us both a better entry price and a safer stop-loss position. Let's say the latest impulsive move started from this point and went all the way up to here. We expect the correction to happen inside this range. From here, we start using the CRT model, but only on bearish candles since the market is in an uptrend. We mark the high and low of each bearish candle and then watch how the next candle reacts. If the next candle breaks below and closes under the range, the setup is invalid, and we don't take a trade. Then we move to the next bearish candle and do the same. This continues until we see a manipulation candle, which sweeps the liquidity below the low and closes back inside the range. That's when we have a valid setup. Now the question is, where do we enter? One simple way is to open a buy position right after the sweep candle closes, but sometimes we may see the price comes back to manipulation phase again to spend more time there, and maybe goes deeper. That even can make us lose the trade by reaching our stop loss, so there's a better and more optimized way, which has much lower risk of losing trade. But sometimes the price will not hit our entry. Anyway, not earning is better than losing, right? To achieve this goal, we should always set our entry positions inside the manipulation phase, which has at least two benefits for us. First, I don't like to enter a trade with equal risk to reward. If there is a move, I want to catch all of it. Second, if our trade goes wrong with this entry, we will not lose too much. When trading CRT with this strategy, never set your entry during the distribution phase, because the price after activating your order can easily return to the manipulation zone before reaching your target. It's a normal behavior of the price in the manipulation phase. Typically, price tends to spend more time in the manipulation phase than in the distribution phase. For example, this is a manipulation candle and a valid setup for CRT. But the problem is, if we open a trade after this candle closes, then our stop loss will be like this, and our profit will be like this. Now imagine this trade goes wrong. During the manipulation phase, the best entry is the order block, because when the market maker creates a manipulation, their moves will print at least a high-quality order block there, and that's where we want to enter. To refine your entry, zoom into a lower time frame for precision. For example, if you're analyzing on the 1-hour chart, switch to the 15-minute, 5-minute, or even 3-minute chart to identify the order block more accurately. And this part is crucial. Never place your order without an identified order block. If everything aligns correctly, you should always see one order block at least in the manipulation zone. Identifying a high-quality order block is the final confirmation before setting your entry. This ensures your trade is backed by structure, not luck.